안녕하세요. So it was my last time I was in Korea was actually in this ballroom, and this was in January 2020, and that was the first time I saw anybody wear a mask. It was actually downstairs in the lobby when I came back from the office. So this has, I always love coming to Korea, but it does have a little bit of mixed memories walking into the lobby again this morning. But so let's move to what I'm here to talk about today. So we obviously have had a very challenging first 6 months of the year when it comes to investing, right? So pretty much everything outside of commodities has lost value this year. So bonds are down, equities are down, the dollar is stronger, so local currencies are weaker. So it's been a really challenging environment for investors. What I'm going to do today is talk about our views for the second half of this year and going forward. But I think before I go there, as Sachin was mentioning, I think the real key point here is to think about where you are on your financial journey. Because it's really important to put that at the forefront of then the actions you take going forward. Because it depends whether if you're fully invested, then we can give you some suggestions on how you might tweak your portfolio. But if you're at the start or not fully invested, or you're at the start of your investment journey, we believe this is a great opportunity to start investing in assets across the board, whether it be bonds and equities, right? So it's really key. We talk about foundation and opportunistic. So foundation is the core of what you should do. It's what you build your financial future on. The opportunistic is a bit more entertaining, a bit more fun, but it should only really be engaged after you've done the foundation work. And I'll spend most of the time talking about what we think of as foundation asset classes today. So our H2 outlook is called walking a tightrope. What do we mean by that? Well, basically we see central banks walking a tightrope between trying to manage inflation, which has soared to levels that I've not seen in my career, right? And also then trying to make sure that we don't head into recession. And it's a really difficult job, right? And so maybe the best way to epitomize it is this chart, right? So this is what's happened this year. So let me explain what these are. So on the left-hand side, you have growth expectations for this year and next, how those expectations have changed over time. And on the right-hand side, you have the same for inflation. And what you can see here, of course, is that you see growth expectations. The dark lines are this year. So for 2022, you can see growth expectations have come down in the US and Europe and in China, right? For next year, they're starting to come down a bit, but obviously most of the adjustment has been growth expectations for 2022. And it's the opposite picture for inflation. Obviously, I'm not that tall, I can't reach up there, but you can see that inflation expectations have been rising, especially in the US and Europe, right? So this is the challenge that central banks are dealing with. They want to bring that lower, but they want to keep this up. But obviously, if they tighten monetary policy, then they will probably bring that lower, but this will come under increasing pressure. Now, to give you some sense of the change that we've seen so far this year, I think this is a great chart to start with. So this is basically what the US Federal Reserve was expecting interest rates to be at the end of 2022. So this is not me saying what they're going to do. This is actually the Fed saying what the Fed's going to do, right? So what this shows was that in December last year, they were forecasting that they would raise interest rates by 75 basis points, or 0.75%, right? So that's what the Fed was saying they were going to do. In March, they said, oh, actually, we're going to do 1.75%, right? So they've already increased. They've more than doubled what they said they were expecting to do there by 3 months later. By June, again, I can't reach that high, right? They said it's going to be 3.25%, right? So the Fed has massively mispredicted or misforecast what it thinks it's going to do, right? So it's changed its view very significantly. Now, this is the sharpest change in interest rate expectations I have seen during my career. But when you add in the fact that when we talk about global financial conditions, there's many different inputs into that. So short-term interests are one input, but you also have bond yields, right? So bond yields have gone up. You also have credit spreads, which credit spreads have widened, which means companies are finding it harder to find capital or having to pay a lot more to raise capital. Equity markets have fallen, again increasing the cost of capital to companies. The dollar has strengthened. And of course, as we all know, commodity prices have risen very sharply. So this is, again, the sharpest tightening in financial conditions that we've seen in my nearly 30-year career in this industry, right? So this is very significant. So the question is then, okay, if you've seen such a massive tightening of financial conditions, is that going to lead to a recession? Well, you can see from the previous slide I had, people don't necessarily think so yet, based on forecasts. But if we're looking forward, these are the indicators we look at when we try to figure out whether we're heading for a recession or not. So there's 14 indicators on this slide. And maybe I'll just give you the codes. So the dark black is basically showing that they're flashing red. So these indicators are saying, actually, the risks of a recession are quite high. The light gray is saying, no, everything's fine, right? We're still strong growth, nothing to worry about. The top one, when we put this chart together, was in the middle, but now that's flipped into black. So we've now got 5 indicators suggesting that the risk of a recession is high, right? Now, if we were to go back 6 weeks, only 2 were black. So only 2 were flashing red when it comes to recession risks. So clearly, moving from 2 to 5 in 6 weeks is not good. So the probability is increasing. Also, if you look at the right-hand side of this chart, these arrows are just basically giving you an indication of whether they're getting better or worse, and down is worse. So you can see that 12 out of the 14 indicators have deteriorated over the course of the past month. So the overall situation is that we believe the risks of a recession have increased dramatically in the past couple of months. And that is, we put about a 40% probability, 40% probability, that we'll see a recession in the next 12 months in the US economy. So against that backdrop, we've come up with 3 key things that we think investors should be considering when it comes to their investments today. Okay? So the first thing is what we call multi-asset investing. This is a great way to get a foundation in place. Multi-asset income investing includes high dividend yielding equities, which are generally more resilient when inflation is high or interest rates are rising. Right? Also includes bonds, where yields, as we'll see in the next slide, are particularly high now relative to history. Right? So overall, this is a good place to hunker down, build your foundation. But what's interesting at this particular point is, if we go back to 2020, you can see that the yield on this was around 4%. Right? So in the past 2 years, it's now gone up to over 6%, which we think 6% income coming from investments is particularly attractive. So that's the first area that we think people can consider averaging into or increasing exposure to at this stage of the situation. So this is the second area we think is interesting, which is bonds. So we talked about bond yields having risen, credit spreads having widened. This is effectively what we're talking about. So the light blue line is where we were at the end of last year. This is where we are today, and the bars are basically the ranges over the past 12 and a half years. And what you can see in most situations is where we are today is at the top of the range over the past 12 and a half years. Right? So we are suggesting people maybe trim their equity exposure somewhat and add to bonds. Now, it may seem a little bit strange to be saying, okay, equity markets are down significantly, and therefore to be cutting now or trimming now might be a bit too late. And obviously, we would have preferred to trim equity exposure at the beginning of the year and rebalance into a bit of cash. But the point I would make with this is that while equities are down globally over 20% year to date, bonds are also down 15%, and that is not normal, right? So now, if you can say that's really bad looking backwards, which it is, of course. If both are down, then you haven't got the usual diversification benefits that you get from bonds and equities. But if you look at it today, the good news is, if you feel that you have a portfolio that is not balanced, then the cost of balancing is much lower. Usually, let's say you're overweight equities have gone down, bonds have gone up, you're selling a cheap asset and buying a more expensive asset. Today, at least you're selling a cheap asset and buying a cheap asset, right? So therefore, the cost of rebalancing, the cost of that medicine is significantly reduced. So this is an area that we think is really interesting for investors. So first was multi-asset income, and second is bonds. Within bonds, there's two areas that we like. So we like Asian US dollar corporate bonds. And basically, this is actually quite a defensive asset class. So 80% of it is investment grade. The yields are relatively attractive. You can see actually very little high yield issuance so far this year. So again, the issuance that we're seeing is coming through is more from investment grade names. So that's the credit quality of this asset class is actually improving over time. So from that perspective, we think the yields for Asian corporate bonds is good. The second area that we like is developed market high yield. And again, we talked about credit spreads widening. That's the blue chart here, the blue line. You can see that we've seen those spreads widen quite significant. So yes, the risks of recession in the US are increasing, but we think that's increasingly priced by markets. Okay, so again, another area to consider when looking at your portfolio. Okay, so I just want to talk a little bit about equities and how we view that before we talk about the third area I want to focus on. So if you see here, this is what we've happened this year. So if you look at the black line on this chart, that is earnings. So that's how many earnings per share of the US stock market. And what's interesting is, despite the fact the market has come down, earnings have continued to go up, right? So we do see, obviously, you can see we do get bouts of earnings weakness. So global financial crisis saw earnings come down quite sharply. Obviously, COVID, we saw them come down sharply as well. But actually, so far, earnings have held up well. Now, obviously, if we head into recession, then the risk is that earnings could start coming lower. And that, of course, can have implications for equity markets. If we see earnings peak, typically you would see that being leading to concerns about the equity market's outlook. The only thing we would say is that we have already seen quite a sharp sell-off in global equities. So if you look in history, when you get a US recession, on average, the pullback in US equities has been 27%. Peak to trough, we've already seen 24%. So one could argue that a recession is almost priced already. And if you see a sharp recession, so these were very sharp recessions here in the global financial crisis, so the earnings drop was sharper, as was the bear market. But if we were to see a shallow equity market or a shallow recession, so quite short-lived, then that would suggest we should be seeing less of a pullback in equity markets. So I think the key point for us is is really, we have discounted a lot of bad news already in financial markets generally, right? So this is, we saw earnings going up. Why have equity markets generated negative returns? Well, because we've seen the valuations fall sharply. So you can see going into COVID, we're around 20 price earnings ratio, slightly over, and now we're around 14, which is around the long-term average, right? So it doesn't mean it can't come lower. Of course it can, but this is not, the big challenge we had at the end of last year was everything's expensive. Well, now everything's not necessarily cheap, but it's not expensive, right? So, and I think this is where it becomes important when you're on your investment journey. You say, okay, if I'm invest in equities, maybe I should trim some exposure, but I shouldn't throw everything out. We talk about throwing the baby out with the bathwater. We definitely, obviously, don't want to do that. So keep some equity exposure. If you're earlier in your financial journey, then this is a great opportunity to at least start adding to global equities, getting that foundation in place, diversifying across asset classes and geographies, right? So I know there's a very strong home bias for Korean investors. We do believe strongly that you should, of course, have local assets, but global assets are important in terms of a source of diversification as well. Within equities, so the third point we'd say is, well, we believe that we're going to see Asia ex-Japan equities outperform global equities. Now, if you think about it from a Chinese stock market perspective, the bear market, actually the peak in Chinese equities was actually January, February 2021. So Chinese equities have already been selling off for 18 months compared to global markets of around 6 months. So they're relatively cheap. Also, because inflation is not a problem in China, the Chinese authorities are able to go on a very different monetary policy path. So they are easing monetary policy, they're easing fiscal policy to try and boost the economy. Right? And you can see here, this is what we call the credit impulse, which is usually a leading indicator of the economy recovering, of earnings, and the stock market. Right? So we believe that we're going to see that lead to better returns for the stock market go forward. Obviously, the key thing for us would be, the lockdowns ending would be really, really positive. Right? So if we see China lockdowns easing, then this should help support the stock market and help it outperform. And obviously, China is a big part of Asia ex-Japan. Another factor that we need to look at is the fact that we see the dollar ultimately peaking out. Once the Fed starts backtracking from tightening policy, and we're not there yet, but once they do that, we'll see this dollar start peaking out in the second half of the year, and that should be good for Asian equities as well. We also like UK equities. So it may seem a little bit strange given the economic challenges that we're having in the UK at the moment and the political challenges with Boris finally resigning from Prime Minister. But what we see here is these three sectors we like, right? Whether it's financials, energy, or materials. And as you can see across the different regions, the UK has the greatest exposure to these sectors. So, and obviously the UK has already seen sterling fall quite a bit, which will also help earnings from its overseas operations. So from the UK perspective, we do see that as a potential outperformer as well in the coming 6 to 12 months. Finally, just on a note on gold. So we are overweight gold as a diversifier. So we do believe this is a good way to sort of hedge some exposures when it comes to portfolios. So we've seen some weakness recently, so gold is obviously not at these levels now. It has come a little bit lower. But ultimately, this is a good hedge around geopolitical risk. It did very well around the initiation of the Russia-Ukraine confrontation and war. And we would expect, if we were to see more geopolitical risk coming through and that dollar weakness coming through as well, that should be good for the gold price. So just as a ballpark, we think 5 to 7% exposure to gold makes sense for investors. Regardless of their risk profile, actually, it's pretty constant at 5 to 7%. So this is a summary of all of our views. So you can see at the bottom we've got the foundation elements that we talked about. So multi-asset income, then adding to bonds and trimming from equities, and then focused on Asia ex-Japan. So that's the foundation views. We do obviously have the opportunistic areas as well. You can see different themes, sector preferences as well, and currency preferences, commodity currencies. But as I mentioned at the start, we believe it's really important to get this foundation piece right first before you worry about the more entertaining speculative element at the top. If you have any questions, please reach out to your relationship manager and IA. And with that, I'll hand back. Thank you so much.